Being directional in zero DTs. All right, I have some ideas here, but I'm going to wait. Let's go. So far, we've explored selling zero DT premium. We've looked exclusively at delta neutral strategies. We've looked at short strangles. We've looked at iron condors in the front month. We've looked at selling front month, buying back month. We've looked at all this different stuff in the zero DTs, but we haven't looked at taking a directional shot. So even when it comes to a broad-based index such as SPX, sometimes traders prefer to act in a directional assumption. Today, let's examine the results of making short premium zero DT trades and how much it matters to be correct. How much do you think it matters to be correct?
I think it's going to be the key to it all.
The key to it all. You don't think that if you're...
I mean, delta neutral is already saying that's a direction, right? I mean, you want to be inside the expected move. So
even the market that we've had in the last year, I'm going to go out on a limb here and say,
okay,
if you sold puts in the zero DTs, total, you made money no matter what. I'm going to say that if you sold calls, not the same.
Okay, agree. I mean, agree. I mean, that would be pretty. That would be the odds-on favorite.
Yep. Let's go to the next slide. Using 1 year of data in the SPX, zero DTs, say we've done all year, collected every 10 minutes. We sold zero DT premium at the market open. We used $10 wide verticals with an initial short strike of the 25 delta, and we used 25 delta short naked puts and calls. Subtract $5 to $15 from the daily P&L, depending how far out you want to go for controlling long strikes if you wanted to reduce your buying power. Winners were close to 25% of max profit. Losers were held to expiration. That's why some of the numbers are lower, because the losers are max, essentially, well, I shouldn't say max loss, but the losers were held to the end of the day. The winners were closed out at 25%. We contrasted the overall results with those when the SPX rose and fell. All the trades were assumed to be filled at mid-price. A little bit of it. That's all we could do. Again, being directional, zero DTs, just short 25 delta puts. So overall, the win rate was 96%. The average P&L was 112. And the CVAR, which is your worst kind of loss, was 3,800. But that overall win percentage is kind of huge. The overall
96%, you think is huge?
Yes, and the overall P&L is huge. But remember, we managed the winners at 25%. Losers we let go to the end of the day. That's been a pretty good trade all year.
Yes, it has been. But the market cooperated too.
When the SPX is up, the win rate's 100%. Makes sense.
Obviously.
The average P&L is even higher. When the SPX is down, here's interesting. When the SPX closes down in the day, the win rate was 90%, 89%. That means we closed down, but we didn't close down much.
That's correct.
P&L was lower, obviously, $67. The bottom line here is that selling puts was a winner-winner chicken dinner.
They're schmutz for a reason.
Puts are schmutz, and selling puts worked, no question about it. So now we're going to do $10 wide put verticals. We're selling the same 25 delta put. Okay, same thing. The win rate went from 96 to 95%. The up days were 100% winners, and the SPX down days still were 88% instead of 89. The numbers were much smaller. You made a lot less money. You took a lot less risk.
Sure.
So you made 1/5 to 1/6 the amount of money. Remember, you're making like $160 or $112. Here you're making $25. But the CVAR was, instead of 3,900, was only the inverse of, if you're $10 wide, the most you can lose is 1,000. So the worst losses were, $875. Okay, pretty interesting.
I live with that.
So selling puts or selling put spreads was worked 95% of the time. It worked 95% of the time. There's nothing else to talk about.
Even a Johnny like me can live with that.
You had small winners, but it worked 95% of the time. So how about selling calls? Well, selling calls worked 90% of the time. The problem is the average P&L was negative.
Right.
Because
that's that large win rate, but not taking any money home with you. That's the key.
Because your worst losses wiped out all your wins. Selling calls was a very different animal. SPX up days, selling calls, you still made money 83% of the time. On down days, you made money 100% of the time. Down days, you made money though. But on SPX up days, selling calls, you lost a lot of money, even though you're right 83% of the time. So this study is really interesting because selling calls, even though you were right a lot, the worst losses wiped you out.
Eat like a bird, poop like an elephant.
So if you're going to sell calls, you kind of got to get out intraday. You can't let it go to the end of the day. If you're going to sell calls and you're wrong, you got to get out. What means if the market's strong, it has a tendency not to bail you out.
So I got to ask you the question, why sell calls?
Because you don't know that we're going to be up every single day for a year.
Okay, I get that. But do the calls give you, it would be interesting to do another study, and maybe this is something that we can do. When we have a strangle, how much of that premium comes from the call? Because we could have an unchanged market. 50%.
We've done this.
Profit.
We've done the studies. And if you're asking why sell the calls, the answer is because selling the calls still adds more money. You make more money when you sell the call and the put than just selling the call. Just selling the put.
Yes.
So that's the answer, is that it works better than just selling one side. This is really interesting because what this suggests here is that if you held these positions to the end of the day that were not winners, the losses were really hard to come back from. Really hard. $10 wide call verticals, same as the last slide, which was not pretty. This is kind of crazy here because average P&L when you sell call spreads was still a loser, even though your win rate was really high, but your CVAR was much lower. So you want to know? I have a takeaway from this slide.
Go ahead.
What strategy, if you're going to have a lower CVAR on the call verticals? So instead of selling calls, what you should sell is call verticals. And what you should do in the 0DTs, based on this research today,
What calls Jade Lizard?
Jade Lizard, it's perfect. You sell the put, sell the call spread. Call spread has a max loss that doesn't, it's 800 or 900, doesn't get you to 1,000.
Doesn't exceed the credit receipt.
And the Jade Lizard wins all the time. That's really interesting. My takeaway from this is the Jade Lizard is the best play on the board for 0DTs, based on today's research. I don't know if that's one of the conclusions the research team came up with, but let's see on the next slide. But that's my conclusion from this, is that selling put, selling call spread is way better than selling put, selling call. Oh, they didn't put it in here. So managing winners and being consistent in the initial delta combined with the put skew made selling puts net profitable even on down days. Agreed. The lower premiums and calls meant being directionally correct was more important. Yes. And the past year has been very good for SPX and thus selling puts. Bear in mind, this is not it's not guaranteed to continue before committing to a very strong directional assumption. Based on today's research, what I would have added to this, the strategy that fits these takeaways the best is the Jade Lizard. Limited upside risk where all the tail losses were, unlimited risk but higher profitability on the short put. Very interesting.